Welcome to another exciting episode of Financial Analysis in Review. Is the economy on the brink of disaster? We're breaking down the latest warnings about a recession and what the housing market signals mean for your investments.
Expert predictions on a stock market crash will have you on the edge of your seat, and we'll uncover what's next for Bitcoin.
Don't miss this critical financial news review. Your wallet could depend on it. Today, we're providing summaries of the top videos from financial experts.
Let's dive right in and tease some key points from these experts. First, Jeff Snyder warns of economic trouble as the copper-to-gold ratio reaches its lowest level since 2020. Next, Gary Wagner predicts gold might hit $2,700 by year-end. Michelle McCory explains why failing fiat systems could drive countries to adopt Bitcoin as a reserve asset. Michael Pettis breaks down China's critical choice between slowing down or exporting unemployment globally. Michael Silva discusses market signals pointing toward a possible recession. Chance Finucane talks about navigating high market valuations amid political tension. Chance Finucane argues that a bear market is inevitable, with the Warren Buffett indicator at an all-time high. Finally, Michael Silva gives insight into the volatile ride of mega-cap stocks in live trading.
First, Jeff Snyder warns of economic trouble as the copper-to-gold ratio reaches its lowest level since 2020. Next, Gary Wagner predicts gold might hit $2,700 by year-end. Michelle McCory explains why failing fiat systems could drive countries to adopt Bitcoin as a reserve asset. Michael Pettis breaks down China's critical choice between slowing down or exporting unemployment globally. Michael Silva discusses market signals pointing toward a possible recession. Chance Finucane talks about navigating high market valuations amid political tension. Chance Finucane argues that a bear market is inevitable, with the Warren Buffett indicator at an all-time high. Finally, Michael Silva gives insight into the volatile ride of mega-cap stocks in live trading. Welcome to Eurodollar University on YouTube. Today's main topic, the copper-to-gold ratio, hit its lowest since November 2020, and Jeff Snyder's here to break down why that's a massive warning for the economy.
Absolutely. Jeff delves into the nitty-gritty of this crucial indicator and what it means for everything, from rate cuts to global economic stability. Strap in for a fascinating ride.
So, what's the main idea behind today's video? What's Jeff trying to tell us with all this copper-to-gold talk?
Jeff's thesis is clear. The copper-to-gold ratio is sending an unmistakable signal of economic trouble. With the ratio hitting its lowest point since November 2020, it indicates a shift from economic growth to contraction, and rate cuts are on the horizon. But that's not good news.
All right, let's break this down. What's the significance of the copper-to-gold ratio?
The copper-to-gold ratio is a potent indicator of economic health. Copper represents economic demand, while gold acts as a fear hedge. When copper prices fall and gold prices surge, it spells trouble. It's like the economy's vital signs are flatlining.
Got it. Now what's happening with copper prices specifically?
Copper. Prices soared earlier this year due to supply issues, not strong demand. Recent declines show weak fundamentals and global demand. No massive rescue from China means faltering economic support. Red flags everywhere.
And what about gold? It's glittering for a reason, right?
Yes, gold is shining bright. Prices are at near all-time highs due to looming economic uncertainty and expected rate cuts. Despite popular opinion, gold isn't an inflation hedge. It's a hedge against financial and economic instability. Basically, people are gearing up for rough times.
Time to consult Jeff's crystal ball. What predictions does he have based on these trends?
First up, rate cuts. Jeff predicts they'll be coming soon. The combination of weak copper and strong gold is a telltale sign. But these cuts are a red flag. They indicate the Fed acknowledges severe economic weaknesses. So, buckle up.
All right, wrapping it up. What are the biggest takeaways from Jeff's analysis?
Jeff sums it up by highlighting the importance of caution. The copper-to-gold ratio, along with other economic indicators, is a potent warning signal. Rate cuts are likely, and they underscore deeper economic troubles. Strategic caution and understanding these signals are crucial moving forward.
Welcome back to the David Lynn Show on YouTube, folks. Today, we're diving into the gold market with none other than Gary Wagner, the editor of thegoldforecast.com. Gary's been on fire lately, and he's got quite the prediction for where gold might be headed by the end of the year.
Absolutely. Gary's expecting a major gold rush. $2,700 by the end of the year sounds like a shiny deal.
All right, let's cut to the chase. What's Gary's main argument here? Why should we be excited about gold?
Gary's thesis is gold is gearing up for an ascent to possibly $2,700 per ounce by the end of this year or early next year. This prediction is based on recent high performances and patterns in the gold market, the Federal Reserve's potential rate cuts, and ongoing geopolitical uncertainties.
Nice. Let's break down those key points. What's been happening with gold recently?
Gold hit a new all-time high recently, with significant jumps since April. Although it pulled back a bit, it still remains highly bullish by staying above critical support levels, just like a yo-yo, but a very valuable one.
And what about the Federal Reserve? Are they playing a tune that gold likes to dance to?
Oh, absolutely. Powell and the Fed have hinted at rate cuts, which have the markets almost certain that cuts will begin by September. He's talking about rate normalization, and it's like music to the gold market's ears.
Sounds like a party, but what else is influencing gold's performance right now?
Apart from rate cuts, geopolitical uncertainties and central banks gobbling up gold at record levels are playing big roles. It's like everyone's invited to jump on the gold bandwagon.
Let's get the crystal balls out. What's Gary predicting?
Gary's seeing gold challenging and possibly exceeding $2,500, ultimately aiming for $2,700 by year-end or early next year. And with multiple rate cuts likely by 2026, it's poised to support these high prices.
Summing it up, how should investors view Gary's insights?
Gary wraps it up by emphasizing a bullish outlook for gold, with anticipated rate cuts, heavy central bank purchases, and a dose of geopolitical drama. Gold is set to potentially hit new record highs. A golden opportunity for investors, if you ask me.
Sounds like 2023 might just end with a pot of gold at the end of the rainbow. Thanks for the insights, and thank you all for watching. Welcome to another engaging episode on Kitco News. Today, we're exploring the intriguing possibility that some countries might begin storing Bitcoin as a reserve asset. Ready for a deep dive with Michelle McCory?
Absolutely. Michelle breaks down why weakening fiat currencies might push several nations to embrace Bitcoin. This trend isn't just a tech fad, it's a financial game changer.
So, what's the crux of Michelle's argument? Are we seeing Bitcoin become the globe's financial lifeline?
Spot on. The core idea is that as fiat currencies lose ground, many countries will pivot to holding Bitcoin as a reserve asset. This shift will be driven by the need to stabilize their economies and circumvent the dominance of the US dollar.
Let's break down the key issues Michelle discussed, starting with the economic vulnerability of certain countries.
Great point. Countries lacking the dollar's hegemony find themselves in a tough spot. Printing more of their own currency only sends interest rates soaring or inflates their economies. It's a lose-lose situation.
And then there's Bitcoin. Why is it becoming the knight in shining armor for these embattled nations?
Bitcoin's appeal lies in its stability and security. As more people and governments start holding Bitcoin, its role as a reserve asset becomes cemented. We're already seeing this with Bitcoin ETFs, which make Bitcoin a palatable option.
Interesting, but the US dollar isn't out of the picture yet. What's its role in this financial shakeup?
Michelle points out that the US dollar has been weaponized, especially evident during international conflicts like the Russia-Ukraine war. This pushes other nations to seek alternatives like commodity and potentially Bitcoin-backed currencies.
What are Michelle's crystal ball predictions? Any big shifts on the horizon?
She predicts the formation of asset-backed currencies, particularly among the BRICS nations and their allies. They could anchor their currencies with commodities and Bitcoin to fend off dollar dominance.
And stateside, what's in store for the U.S.?
Expect some turbulence. Interest rates might spike as global investors sell U.S. debt, potentially triggering bank failures and escalating economic instability. Buckle up.
To wrap things up, what are the biggest takeaways from Michelle's insights?
Michelle highlights the inevitability of countries shifting to Bitcoin and commodities as the U.S. dollar loses its grip. This means big changes for national and international financial structures. It's a call to be prepared for a new era in global finance.
Welcome to Blockworks Macro on YouTube. Today we're diving into a critical discussion with Michael Pettis, who is professor of finance at Peking University and also a senior associate at the Carnegie Endowment for International Peace. The topic: the intricate choices China faces between economic slowdown and exporting unemployment to the global stage.
Exactly. Pettis has a wealth of knowledge, and he doesn't hold back. Let's take a closer look at his insights on China's precarious balancing act.
So what's the meat of Pettis's argument here? What is China caught between?
The crux of it is that China's investment-driven growth model is reaching its limits. They have to decide between slowing down their economic growth or continuing to invest heavily in manufacturing, which could escalate global economic imbalances.
Let's break that down. What's happening with China's economic landscape?
For starters, China has an unusually high investment rate, at 43% of GDP. They heavily relied on the real estate sector, which accounted for 1/3 of all investments. But with a crackdown on real estate in 2021, things are shaky.
Okay, so they're moving away from real estate investment. What's next?
They're attempting to pivot from real estate to manufacturing investments. But this is tricky because it requires accommodating this shift globally. Their manufacturing share has to rise much faster than their overall GDP share, putting pressure on international markets.
Interesting. What about their domestic consumption?
That's the big challenge. Boosting domestic consumption means increasing household income. This requires significant policy shifts that could strain other sectors like local governments and businesses. It's a tightrope walk.
So, crystal ball time. What's Pettis predicting for China's economic future?
He foresees that China's current strategies will increase global economic tensions. They might end up making large fiscal borrowings to boost short-term consumption. However, that's not a sustainable fix, more like a Band-Aid on a bullet wound.
And what about the global impact?
If the U.S. moves to curb foreign capital inflows, surplus countries like China will have to adjust their savings and investment balances domestically. This could lead to significant economic shifts and potential turmoil in global trade dynamics.
So wrapping up, what are the main takeaways?
Pettis makes it clear. China has some tough economic choices ahead. Balancing investment and consumption while managing global pressures is no small feat. Strategic caution and effective policy planning are key to steering through these turbulent times.
Absolutely. Navigating the upcoming economic landscape requires agility and insight. Thanks for tuning in to Blockworks Macro. Don't forget to like, share, and subscribe for more insightful discussions. Hey there, Money Marvels. Welcome to Figuring Out Money on YouTube. Today, we're diving into some real market wizardry as we explore recession fears, key signals, and some sharp market analysis, all wrapped up in one insightful video.
Absolutely. Michael Silva breaks down the copper-to-gold ratio, yield curve, market volatility, and the Federal Reserve's next moves, all pointing to a possible economic downturn. Buckle up, folks. It's going to be an enlightening ride.
All right, what's the main takeaway from Michael's analysis? Are we heading towards a recession?
The core thesis is that several economic indicators are flashing warning lights. Specifically, Michael focuses on the copper-to-gold ratio and the yield curve, both suggesting that a recession might be looming over the horizon.
All right, let's break down those key points. Starting with the copper-to-gold ratio. What's happening there?
Gold is on a high, hitting record prices, while copper is losing steam. The declining copper-to-gold ratio historically correlates with approaching recessions, making this a significant red flag.
Next up, yield curve analysis. What's it signaling?
Michael points out that every time the yield curve uninverts, a recession typically follows. Although we haven't reached full uninversion yet, past patterns suggest it's a critical sign to watch.
Interesting. And what about the Federal Reserve's rate decisions?
There's a strong chance the Fed will start cutting rates soon, likely in September. Rate cuts usually signal economic distress and often coincide with recessionary periods.
Moving on to market volatility. It's been quite the roller coaster lately, hasn't it?
Absolutely. High volatility is evident, with indices like the S&P 500 and NASDAQ moving wildly. Michael uses Bollinger Bands to suggest that this kind of turbulence could continue, echoing patterns we saw in 2007.
And what are we seeing in terms of unemployment and inflation?
Unemployment is over 4%, which is an early recession warning sign. And while inflation has decreased from its peak, it remains stubbornly high. This dual challenge complicates the Fed's actions.
All right, crystal ball time. What predictions does Michael make?
Michael predicts that we could see a recession soon based on the dropping copper-to-gold ratio, yield curve patterns, and impending rate cuts. He also anticipates continued market volatility, with possibly some short-term bounces amidst the broader bearish trend.
Wrapping it all up, what's the big takeaway?
Michael emphasizes caution in investments, urging viewers to stay informed and watch key economic indicators. The main message is to prepare for potential market turbulence and be strategic with your financial decisions.
Welcome to Oxbow Advisors' YouTube channel. Today's episode is chock full of market insights with Chance Finucane, the person steering the ship at Oxbow Advisors. We're talking market outlook, high stock valuations, and how to navigate these choppy waters.
Absolutely. Chance is diving deep into how recent political events, especially the attempt on Trump's life, are shaking up market sentiment. Hold on to your seats.
So, what's the main argument Chance is putting forward in this interview? What's his big takeaway?
The core thesis here is that Chance isn't letting political surprises dictate his investment strategy. While the markets are reacting to the Trump incident, he's focused on high valuations and staying grounded in fundamental analysis.
Let's break it down. How did the market respond to the Trump incident, and what does Chance make of it?
Markets saw a spike with increased chances of a Trump win driving stocks higher. Chance notes this reaction, but emphasizes that he won't let politics dictate his investment choices.
What about potential Trump policies? Any impacts on the market there?
A Trump win could mean more fiscal spending and tax cuts, which might push 10-year yields higher. However, unlike the significant impact of past tax cuts, any future changes would likely be smaller.
Valuations seem to be a hot topic. What does Chance say about the current market indicators?
Absolutely. Using indicators like the Buffett indicator, he points out that market valuations are at record highs. This suggests a correction is on the horizon. Even accounting for overseas earnings, things seem overextended.
And what's his take on AI and tech stock valuations?
Chance believes they're overheated. While these stocks have shown tremendous growth, the current prices might already reflect all anticipated gains. Definitely not the time to jump in headfirst.
So what does he predict for the economy?
Inflation could become sticky towards the end of the year despite some recent declines. He expects a single rate cut from the Fed in September, not the aggressive multi-cut predictions from some corners of Wall Street.
And the yield curves, how does he see that playing out?
The yield curve will probably stay inverted until a serious growth slowdown or recession comes into play. Short-term treasuries are a safe bet, offering a solid 5% annual return.
With all the hype around tech stocks like Nvidia, what's his strategy?
He's cautious. Chance thinks current prices are way too high and expects significant declines. Instead, he's seeing value in stable sectors like energy, healthcare, utilities, and consumer staples.
So, what's Chance forecasting for the near future?
He's predicting a single rate cut in September, with more possible if growth slows down significantly. Also, expect inflation to spike again towards the end of the year.
Wrapping it up, what's the big takeaway from Chance Finucane's interview?
Stick to fundamentals and stay cautious amid high valuations and political uncertainty. Avoid chasing overvalued tech stocks. Instead, look for value in more stable and underappreciated sectors. Solid advice for navigating today's market.
Welcome to David Lin on YouTube. Today, we have Chance Finucane, the CIO of Oxbow Advisors, joining us to unfold the grim episode of an inevitable bear market and the soaring Warren Buffett indicator. Buckle up for some crucial investment insights.
Absolutely, Chance brings a treasure trove of expertise, and today's talk is packed with analysis on market trends, political influences, and those ominous valuation metrics. Ready to dive in?
Let's get straight to the heart of it. Why does Chance believe a bear market is looming over us?
The core thesis here is that a bear market is inevitable. The Warren Buffett indicator, which compares total market cap to GDP, is hitting record highs. This overvaluation suggests a significant market correction is just around the corner.
All right, Let's unpack those key points. What's driving this market doom and gloom?
Firstly, we've got growth slowing down for the rest of the year. This isn't a great omen for cyclical industries or small caps. Additionally, tech and AI stocks, which have been the market darlings, are expected to pull back rather than seeing other sectors climb to meet them.
Got it. Now, what about those political factors? How do they muddy the investment waters?
Well, a recent example is the assassination attempt on Donald Trump. While these events might cause short-term market jitters, Chance advises not to overhaul your portfolio based on political outcomes. Stick to your strategy.
Good to know. Now let's talk Warren Buffett. Why is everyone freaking out about this indicator?
The Buffett indicator is at an all-time high, meaning market valuations are heavily inflated. When you see such high valuations, it's usually a sign that a market correction is in the cards. We're probably in the top 10% of valuation history here.
On to the crystal ball segment. What are Chance's predictions?
First off, inflation is likely to be more sticky, remaining high towards the end of the year. We might see a rate cut from the Fed in September, but multiple cuts? Unlikely, unless we see a dramatic growth slowdown.
And about that market correction?
A correction is pretty much a given. Tech stocks, including semiconductors and AI-related companies, are expected to see significant pullbacks, aligning with the overall correction.
So, how does Chance advise us to navigate through this storm?
Strategic caution is the name of the game. Chance suggests rebalancing towards less overvalued sectors. The emphasis remains on not overpaying for stocks no matter how much market enthusiasm there is. Stay vigilant, folks.
Hey everyone, welcome back to Figuring Out Money. Today's episode dives into the wild ride of live trading, specifically looking at megacaps, selling, expected moves, gamma levels, and stocks to watch. Joining us as always for his astute commentary is Michael Silva.
Absolutely. Today's market conditions are as volatile as it gets. Michael goes in-depth into the current sell-off in megacaps and how understanding gamma levels can help us navigate the turbulence.
So what's the big takeaway from Michael's analysis today? What's driving all this market frenzy?
The core thesis here is that we're in a highly volatile period driven by sell-side activity in megacap stocks. Michael underscores the importance of understanding gamma levels and expected moves to identify trading opportunities during these turbulent times.
All right, let's break this down. What's causing all this volatility?
Volatility is spiking due to significant sell-side activity in megacaps. Michael explains how we're operating below the gamma flip line, which triggers more selling or buying responses, creating these wild market swings.
Interesting. What about those gamma levels and expected moves?
He highlights specific gamma levels, especially the 5550 range. These levels can act as pivotal points in the market where significant activity might occur. Expected moves help us understand the potential range for the day's trading, indicating where the market might reverse or extend further.
Got it. And what's Michael saying about individual megacaps like Amazon and Microsoft?
He goes through each one, noting the sell-side pressure they're experiencing. However, there are positive divergences, particularly in Amazon and Microsoft, suggesting they might be ripe for a rebound. It's all about timing and awareness of these divergences.
And how about the overall sector performance?
He mentions energy performing robustly compared to the broader market, and that consumer staples and utilities are also holding up relatively well. These might be safer havens in the current market turmoil.
All right, let's talk about predictions. What does Michael see happening in the near future?
He anticipates potential bounce-back opportunities in mega-cap stocks due to their oversold conditions and positive divergences. Staying aware of key gamma levels will be essential for navigating these bounces.
And with earnings season coming up, especially with Netflix and Nvidia,
earnings will definitely add more volatility. Michael advises tracking implied volatility and expected moves to manage our positions and risk effectively during the releases.
Wrapping it up, what should traders focus on?
Michael emphasizes the need for strategic caution right now. Understanding gamma levels and expected moves is crucial. Look for divergences and manage your risk wisely to navigate these choppy waters.
Jeff Snyder's insights reveal a warning sign from the copper to gold ratio. Gary Wagner remains bullish on gold, predicting it will hit $2,700 by year-end.
Michelle McCory's analysis points to countries turning to Bitcoin as a reserve asset. Michael Pettis highlights China's critical economic decisions.
Michael Silva sees recession signals are looming. Chance Finucane and Chance Vukan provide strategies for navigating high valuations and political tensions.
Key agreements include anticipated rate cuts and the potential for increased economic volatility. Differences lie in market correction predictions and safe assets.
Stay tuned for more analysis. Don't forget to like and subscribe. Thanks for watching Financial Analysis in Review for July 19th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.